The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 7th of May, 2021. On the podcast today, Dr. Clifford Gross, Executive Chairman of Tekcapital, provides an update on their portfolio of disruptive technology investments. Plus, Majid Shafiq, CEO, and Graham Heath, CFO of i3 Energy, talk through their operational and financial progress from their assets and operations in the UK and Canada. Also, Derek Liu, Executive Director of Blue Star Capital, provides a general update in respect of its investee companies in the esports, payments, technology, media and gaming sectors. And Paul Hill, full-time investor and equity analyst, talks about the UK's bounce back, why Bitcoin's insane, Zak Mir's chartist challenge, the importance of discipline and patience in investing, and the following companies: SourceBio, Oncimmune, Polarean, Proactis, Lloyds, Totally, Eleco, Taylor Wimpey, and Trackwise Designs. Plus, at the end of the podcast, if we've got time, I've got two lists for you: the top 5 most followed companies on Vox Markets in the last 24 hours, and the top 5 most read RNSs too. By the way, you can check out both these lists at voxmarkets.co.uk. We'll see lots of other content. In fact, there's an article there on Jersey Oil and Gas. There's one there on Love Hemp and Alba Minerals and Zach's Traders Cafe, Chamberlain, Deep Verge, Mars Energy, Developments, Perez and URU Metals Charts, Sensine Health, lots there. And I always like to check out the COVID-19 index. The top there, biggest riser, is actually Tekcapital. It was on the podcast today, up 15% to 15 pence. Biggest faller, Omega Diagnostics, down 5.42% to 78.5. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Dr. Clifford Gross, Executive Chairman of Tekcapital. TEK is ticker there. Cliff, good to chat to you. Haven't chatted for a while.
Yeah, it's been a while. How are you keeping?
Yeah, very good, thanks. And we were just talking about how it's the COVID vaccines in America are doing very well. You can even get a drive-through vaccination.
Yeah,
that's amazing.
Yes, you can. You get a Happy Meal on the other end.
Okay. Well, listen, you just released your final results. Lots going on and news since as well. So we're going to have a fly through all the investment companies' portfolio there if we can. Before we get into that, Cliff, for people maybe not familiar with Tekcapital, just give them a brief overview as to what you're all about, please.
Yeah, sure. We commercialize university discoveries that we believe could make a positive impact on people's lives. And we do it basically two ways. One, we build portfolio companies around select technologies that we acquire the rights to, and we drop in star power management to those companies and some capital to get them on their way. And the second way that we do it is we help universities around the world commercialize their innovations by providing a number of services. We currently have about 250 university clients worldwide.
Yeah, excellent stuff. And just a top line here on your financials. Net assets increased 45% to 32 million US. That's a record level, of course. Net increase in fair value of 8.7 million, and profit after tax 7.7 million. So it's doing very well. But let's fly through operationally. Let's start off with Solarius, if you could, then, Cliff. What's happening there?
Making good progress. They have about 24 major companies that are testing very rigorously the use of microsalt to replace their existing salt in their snack foods. And this has been going on for over a year. And encouragingly, about 2 weeks ago, several of those companies came back and asked for pricing. So we're quite thrilled that they're making good progress. They introduced about a half a year ago a snack line called Salt Me Crisps, which are sold in stores and on Amazon. They have over a 70% 5-star rating. Customers really like them, and so that's going well. And then they're planning to launch later this year low sodium salt packets of microsalt that will be available in supermarkets and in restaurants and convenience stores. And we think that's really a needed product. It'll be the first all-natural, low-sodium, non-GMO, kosher salt packets that you could use, just like you would use, say, Splenda. If you wanted to reduce your caloric consumption, you could use the microsalt packets to reduce your sodium consumption, and you can put it on your dinners or salads or whatever you're eating. They're doing quite well. They've recently onboarded Dr. Jay Shah, who's a cardiologist at the Mayo Clinic, as their medical advisor, which is really a vote of confidence in the scientific veracity of their product. And we think this is going to be a major year for the company.
Excellent stuff. Okay, let's go to Lucid, which is, of course, a designer prescription eyewear with smart features. Where are you at with that at the moment, Cliff?
Well, they hit a really great milestone this year. After developing a couple of beta products, which had some redeeming features, but didn't quite cut the mustard in terms of being mass market and enabling, they finally came out with a product that's really quite thrilling this past January called Lucid Light. And the customers love them. They just love them. They're in the third production run already. They can't keep them in stock. They have over 100 five-star ratings in the last 6 weeks. They signed up D. Langstrom Associates in Minneapolis, which is a distributor to big box retailers, to try to get them onboarded by some of the largest retail chains in North America. And just yesterday, they added 3 staff members. The company's growing very rapidly. One of the gents was previously the manager of eyewear for Guess. He built tremendous distribution for Guest eyewear in the hundreds of millions of dollars a year, and so they're developing the eyewear channel, they're developing the sports marketing channel, and they're developing the social media channel and the big box retailer channels, and those are all the channels for smart eyewear. But what Lucid did that was really great is to make eyewear that's technology enabled go mainstream. You have to do 3 things. They have to look good, and they've designed a product that really does look quite fetching. It has to be comfortable, which means comfort is a proxy for weight when it comes to eyewear. Typical eyewear weighs about 1 ounce, and the Lucid glasses weigh 1.25 ounces roughly. Mm-hmm. And so you can wear them all day, which is critical, especially if you have a prescription in them. Mm-hmm. The other thing is price. They have to be priced the same as regular eyewear. That's what the market's calling for. And Lucid's manufacturer's suggested retail price is $149. So they're priced the same as regular eyewear. They look like designer specs. They're comfortable. The battery lasts all day, which is also important for prescription eyewear. And so they finally checked all the boxes. No one ever did that before in the smart eyewear space. And now they have the team that actually can go out and leverage all the different distribution channels, including social media for their e-commerce sales. So we think Lucid's going to be a home run. We think it's going to be a big business. In the U.S. alone, the online prescription eyewear sales are about 3.8 million units a year, growing very rapidly, and that doesn't take into account sunglasses, which is also a huge market. So we think they have the potential to become a very significant company in a fast-growing space, and they have the first sort of mass market ready intelligent eyewear product. And then this summer, they're launching Verb as it comes out of beta, and Verb will be it's really quite amazing. It's an app that you can use to upgrade your glasses, and that allows you to listen and respond to social media just with your voice through your glasses or any other hearable. Like if you have AirPods in, you could use those as well. So you don't have to take the phone out of your pocket. You don't have to key in tweets on your keyboard, on your phone. You could just speak it. And so it brings voice into social media. And, voice has been a sort of a missing element. Most social media is, it's either text-based or image-based. And voice gives a certain authenticity to the communication. But it's also hands-free, and it's also inherently safer. So you can keep your eyes on the road, if you're riding your bicycle or walking or jogging or doing any other athletic activities. So the Lucid glasses, correct your vision, protect your eyes, and allow you to remain connected to your digital life. So we think they're going places.
Yeah, do you know what? Two things you mentioned there that are very significant, I think. When you say that you have these smart glasses and they're comparable on every level pretty much with normal glasses, but they've got this extra bit where it's smart as well, sort of, it's pricing, weight, look, comfort, all that stuff. And also, you're right, I hate typing. I absolutely hate it. And you can see now, in fact, the Clubhouse, there's some apps now that they are enabling audio, and they're getting very popular because it's so much easier, more natural. That's why I do podcasts rather than write blogs. It's so much more natural to talk rather than type, So,
Absolutely.
Very interesting.
Clubhouse is a great example.
Yeah.
Clubhouse just recently did another private round. They're pre-revenue as well. And their pre-money valuation was about $4 billion. And we think the Verb product, I don't want to talk about it too much because it hasn't launched, but we think it's a world-class product in terms of voice-accessible social media. So that's on top of these really nice glasses, which you could use not only to make and take calls and listen to music, but you could talk to Siri or Alexa. It's really great. I mean, I wear them all day. I mean, they're really fabulous glasses, but they have some really interesting technological capabilities. So, for example, let's say I'm walking around the block where I live. I'm listening to some Polarean. I get into my car. The glasses automatically switch over to the Bluetooth in my car, and the music comes through the car stereo system. I don't have to say anything or touch anything. It just knows to do that. And I'm listening to the music, and I can say, Alexa, what's the distance between Miami and New York? And Alexa will say 1,200 miles as the crow flies. And then I could say, Alexa, play David Bowie Under Pressure. And then it would just change. All this is done, without missing a beat. I don't have to look anywhere special. I don't have to key anything in. I'm just controlling with my voice the information flow that I want to get in a very seamless way. And it's quite an achievement for a young company to have produced a product of that caliber.
Yeah, absolutely. Let's move on to Guidant now, which is, of course, developing remote monitoring and control software to improve the safety of autonomous vehicles and land-based delivery devices. So what's happening at Guidant, Cliff?
Well, they just demonstrated their core technology this week, and there was a press release in RNS that we had published describing it with a link where you can actually see Guidant remote monitoring and controlling an electric vehicle. The reason why this is important is autonomous vehicles are coming, and everybody sort of realizes that. And there will be fewer accidents with autonomous vehicles once the fleet is mostly or completely autonomous. Obviously, there'll be fewer accidents because the human error will be obviated. But the accidents that will occur, and there will be accidents, there will be mishaps, are more problematic in many ways because in most instances there won't be a driver. And in many instances there won't be passengers. There may be injured pedestrians, but there won't be passengers. So there's no one to get out and call a first responder and kick the tires and resolve the situation. And so the construct is that to do that safely, you really have to be able to virtually drop in a human operator into the situation to resolve the mishap or help resolve the mishap. So that's the theoretical basis for it. But in actuality, in the state of Florida last year, Governor Ron DeSantis passed a law legalizing the operation of autonomous vehicles anywhere in the state of Florida, even without a driver. But if you have no driver, which these delivery devices, of course, have no drivers, you have to hook them up to a remote monitoring and control center so that in the event of a mishap or an accident, someone could drop in virtually into the situation, survey the landscape, look through the camera lenses on the vehicle, speak to pedestrians if they're nearby, and take over control of the vehicle if it's still operable and move it out of harm's way off the roadway. The only problem with that whole equation is there's no remote monitoring and control center in the state of Florida yet. So Guidant is building the first remote monitoring and control center in the state of Florida using the technology they demonstrated this week. And they're hoping to have it fully operational by year's end and onboard one or more major customers. So it's extremely exciting. Guidant has made enormous milestones since it became operational 2 years ago. They have a couple of really redeeming features. First of all, they have a terrific management team. Harold Braun is a first-class gentleman, extremely knowledgeable. He was former CEO of Siemens Networks, which was a large company and employed 4,000 people in Boca Raton. And Johan Denischen, who's on the board, is the COO of Volkswagen North America, which is a big operation, 8,000 employees. And then Daniel Grossman, who was one of the developers of Zipcar before it was sold to Avis Budget, and then it was hired by General Motors to run Maven, their first mobility company, as COO. And now he's on the board of Guidant and also chief revenue officer. So they have the high-level board. They have a wonderful technical team, mostly populated from individuals that the board members have worked with previously, and they have 7 patents right now, and they have more in development. So they have the IP, they have the tech, they have talent, and they're addressing a white space in the market. They're building the first remote monitoring and control center in Florida, and if that is successful, which we believe it will be, they'll roll it out to other states and then other countries. We think that's going to be the standard. It's basically like OnStar next generation, on steroids, but you can actually take over control of the vehicle, not just talk to people on the vehicle.
Yeah, absolutely. Huge area. I mean, even in the UK, the government said at the end of this year there'll be autonomous vehicles on the road being trialled and all that stuff. So a very interesting space. Okay, and Bellascura, take us through what's happening there, if you could, Cliff.
Yeah, Bellascura has achieved a major milestone. They, as you already probably know, they've developed what we believe to be the world's most advanced portable oxygen concentrator. They submitted it to the FDA in December 2020, and it got cleared by the FDA in March 2021. And they're hoping to go into production with the product this year. So they have a product that has, the ability to make portable oxygen concentrators more affordable for people worldwide, which would be a terrific thing to do.
Yeah, absolutely. Okay, Cliff. Well, probably hard to keep it to 3, but if you could, for people not following the company but liking the sound of what you're doing here, give them 3 quick reasons why they should hit that follow button on your page and add Tekcapital to their watch list, please.
Well, Tekcapital is a great company. Our basic competitive advantage is we've built this large university network that allows us to select from about 4,500 institutions around the world IP that we feel could address major problems that are unmet, that can improve people's lives. And we've used that network to sort of mitigate selection bias in the formation of the companies that we've put together. And each of the companies that we have, Bellascura, Guidant, Solaris, and Lucid, if they are ultimately very successful, they will improve people's lives around the world, and that's a good thing to do. But they will also produce, in our opinion, meaningful returns on the invested capital, which is important for the company and its shareholders. So I think that's very exciting. Our hope is that over the next 2 years, all of these companies are either public companies or acquired. And we think that's realistic, and that's what we're gunning for.
Excellent stuff, Cliff. Good to chat to you, and hopefully we'll catch up in the not-too-distant future. Thanks very much.
Oh, my pleasure. Thank you.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Majid Shafiq, CEO, and Graham Heath, CFO of i3 Energy, i3E. Stick it there, guys. Thanks for joining me.
Thank you, Justin. How are you?
Yeah, good. And it is nice to speak to you because you've operational and financial update. We haven't spoken for a while, but lots going on, lots changed, and you're progressing, significantly by the looks of the production there. So before we get into that, guys, just for people maybe not familiar who haven't heard you for a while, just explain, could you, what i3 Energy is about, please?
Yeah, Justin. So i3 Energy is an oil and gas company. We're listed in London and in Canada. We have assets in the UK and in Canada, production assets in Canada that we will be talking about, and an appraisal asset offshore in the North Sea in the UK that we're looking to move forward towards appraisal and ultimately development.
Yeah, absolutely. Marvellous stuff. Okay, so the update, lots in there. Let's start off with the production. You've announced production for the quarter of 8,856 barrels of oil per day. How do you see that developing this year?
Yeah, well, hopefully we see it developing positively. But if we look at our asset base that we acquired from Gain and Toscana, we were expecting. If you look at the competent persons reports that were generated for the RTO purpose, they had predicted declines in there, and our production is producing much better than that. So, on average, we would have expected around about a 13% decline per annum, and the fields look like they're declining at less than around about half that. So the production's holding up really well. The assets that we've acquired are really good assets, and the guys in Canada are doing a really good job of maintaining that production. So a spectacular job really on top of it. So we're really pleased with the asset base. We would expect, if the assets were to decline at the rates projected by the competent person, we'd be shy of 8,000 by the end of this year. If they continue to perform as they currently are, should be around about 8,500 BOE per day by the end of the year.
Yeah.
So our expectation is that the assets will continue to perform better than expected. But we have a number of catalysts in the portfolio, one of which I've mentioned in an RNS, which is the Knoll well, excuse me, which should be on stream in June at around about 500 BOE per day. It's a gas well. And there are a number of other opportunities as well in the portfolio that we've now started to look at in detail. Older fields where perhaps the reservoir management hasn't been as good as it should have been. The assets in Canada are operated slightly differently to the way that they are in the UK. There's just so many drilling opportunities that they just tend to get drilled up in a certain manner. Whereas in the North Sea, for example, we can't drill as many wells, so reservoir management's a lot more important. And what we're finding with the portfolio there is that there are opportunities to increase production from the existing portfolio, and we're hopefully we're looking at a number of different projects of that nature, which we're hoping we will be able to execute on over the next 6 to 12 months to increase production from the current portfolio. In addition, we announced a farm in the Clearwater play in the RNS earlier this week, and preparations have started to start drilling according to that farming agreement, and we're planning. We have to drill 2 wells by November, another 4 wells by March, and then we have a potential to drill another 3 wells, so a total of 9. What we're focusing on a particular area initially in the Martin Hills area in the Clearwater, which is a development play essentially. So these wells can be drilled and tied in and put onto production within a month. That work's already started. Each well, we're assuming each well will have an initial rate of around about 150 barrels per day. That's our kind of middle expectation. Although there are a number of wells that have been brought on by competitors in the area at significantly higher rates than that, but we're putting out conservative assumptions on that. But there's 2 wells that will be drilled before November and will actually be drilled within the next couple of months, and they should come on, as we say, around about 150 barrels a day each. We have 50% of those, so our gross will be 150 if they come on at that rate. So, in terms of where we will be towards the end of the year, I'm hoping that we'll be, around about where we are at the moment, and possibly better than that.
Yeah. And just going through that, you talk about the Clearwater there, lots of activity there and that play. And, for people in London like myself here, not familiar with it, just why is that an area to focus on then, Majid?
Yeah, so the Clearwater play is the best play onshore Canada at the moment, and it's a relatively new play. It's been developed from around about 2016 was when the first wells were drilled, but since that point, over 400 wells have been drilled in the play, and it's producing in excess of 30,000 barrels a day in total. The reason it's so good is that it's firstly it's got good poroperm characteristics, so the rock is good. which means it doesn't need to be fracked. We hear a lot about onshore Canada in the US with the new plays, both tight gas and shale that have to be fracked, with many fracks in horizontal sections. And those wells are relatively expensive and they decline very quickly. We don't need to do that here in the Clearwater because the reservoir quality is good. They're also at relatively shallow depths, so they can be developed with horizontal multilateral wells at relatively low cost. They're around about $1 million each to drill, complete, and tie in, and all of that work can be done within 30 days, so they can be brought on very quickly. And it's 100% oil. So all of that means that the economics for those projects are really good, and they tend to be, if you have those wells in your portfolio, they tend to be right at the top. So we're very lucky in that the company that we acquired, Toscana, had built up a really large position in the Martin Creek area of the Clearwater play. And it's in total we have about 150 kilometers squared there. The issue with that acreage is that it's in an area where the government's trying to protect the caribou. So we're not allowed to work there from February to July. We're not allowed to access it. In addition to that, it's very boggy conditions, so we only have access in the winter. But the positive about that acreage for us is that we have it's been developed for gas production. So there are 150 wells that have been drilled. So there's surface locations, around 150 surface locations, and gas pipelines connecting all of those and going into a gas plant. And the gas production facilities, they were discovering that they were finding oil in the separators and in some of the tanks and the slug catchers. So clearly there was oil coming up with the gas. And so there was a strong suspicion that this acreage had oil in the Clearwater play that had been developed elsewhere in that area. And so we went in the first quarter into 3 wells and recompleted these wells in the oil zones and found oil in 2 of the wells, as we'd expected there to be, which gives us strong confidence that we're going to have oil across the play in the Clearwater. So what we'll be doing is when we get back into winter conditions again and can access the acreage late this winter and early next year, we're going to go back in and look at a drilling program to start development of that fairly large portfolio that we've got there. But what we wanted to do was to grow our position across the Clearwater, outside our existing areas, and also to acquire some areas that already have roads built and so have all year round access. And so that's the reason that we farmed in and did this deal. It's given us another around about 30 kilometers squared, or access to around about 30 kilometers squared of the Clearwater play, which we will earn if we drill the 9 wells that are part of that agreement. But yeah, so the Clearwater it's a position that we're very lucky to have a very large position in, and it's one that we do want to grow because the economics are very good, and it's oil production which has the best margins.
And just to add some quantification around that farm in that we've just struck, Justin, it's important for our shareholders to understand that we have a really a sizable gas production base, and that adds stability to our cash flow in our portfolio. But certainly the highest torque in the portfolio comes from oil and heavy liquids-based assets. The farming that we've conducted gives us the opportunity to drill up to 9 wells, and as we quoted in the RNS, those could produce at, let's say, 150 barrels of oil per day. Up here in the area, said yesterday in a press release that they're seeing production levels that are 20% higher than that at the moment. But at the 150, what that means for our portfolio today, we've got just under 1,500 barrels of oil per day out of the circa 8,800 that we're producing. These 9 wells, which we'll sort of own on a 50% basis as a partner, could add another 46% of that, almost 50% to our oil production base. Our oil production, our 1,466 barrels of oil per day, contributes about 40% of i3's total current cash flow. So, this farm-in opportunity, therefore, could add, another 20 to 25% to our cash flow levels from where we're at today. So it's a really meaningful farm-in for us, and at the benefit of the fact that these wells pay back in less than a couple of years. The latter wells will have sort of a 1-year payback. So where our peers are still, they're buying assets in the market, at posted multiples of 3+ times, 3.4, 3.7 times. We're buying these assets still for 1 to 2 times cash flow. So it was a great strategic add for us.
Yeah. And in fact, talking about cash flow, it's quite appropriate to talk about dividends. So what are the steps now you have to take before you can pay that?
Yeah, look, we were hoping that we would have paid the dividend by now. And I know our shareholders are becoming impatient in that regard. It's a court-led process in the UK for restructuring your balance sheet, and the court-led portion of that comes on the back end of all of the approvals. So you have to make sure that you get all of the components that you're feeding into that process right before you kick it off. So on this side of it, otherwise we could come to the back end with a failed restructuring. So the court-led process comes on the back of an extraordinary general meeting of our shareholders. We can't actually, enter into the court-led process nor that extraordinary general meeting for our shareholders prior to getting the correct documentation in place, making sure that our balance sheet was in a state that would almost guarantee that will go through in the court-led process, but that we also have to get creditor approval. And we've got a number of creditors who we required approval from in order to go through that balance sheet restructuring. So, look, all of those components are lined up now. We expect to be sending out the notice of the extraordinary general meeting to our shareholders in a very short time period. And then on the back of that, we'll immediately apply to the courts for the restructuring. With all of those approvals in place, we would believe that it would go through smoothly, and immediately thereafter, as quickly as we can practically affect it, we will pay the dividend. So we're looking forward to that.
Yeah, well, I bet shareholders are looking forward to that as well. And guys, final thing, as always, 3 reasons if someone's listening right now, not following the story, but liking the sound of the progress here, give them those 3 quick reasons why they should hit that follow button on your page and add you to their watch list, please.
Yeah, number 1, we have a solid production base now to support, a very solid core base value in the stock. I think that's the first reason. Secondly, we're shortly going to be commencing dividend payments, which will be supported by that solid production base. And, thirdly, there's a potential for significant growth in income in the form of dividends and also in share price growth. Because we have, multiple catalysts now across a broad portfolio in the UK with the Serenity asset and, multiple catalysts in Canada. So strong, probability that we will see strong growth both in the share price and, progressively grow the dividend.
Excellent stuff. Majid, Graham, thanks very much for coming on, and hopefully we'll catch up in the not too distant future. Thanks a lot.
Thanks, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Derek Liu, Executive Director of Blue Star Capital, BLU is ticker there. Derek, thanks for joining me.
Justin, great to be with you.
Yeah, and you've done an update on your investment portfolio recently in RNS, and lots of detail in that, and we'll dig into that in a bit. But as always, if someone's listening right now, Derek, and don't know what Blue Star Capital is, could you just summarise quickly what you're all about?
Yeah, I'm more than happy to. I mean, Justin, really good to be here with you guys, and welcome to all of your listeners. Really hope they enjoy hearing about what Blue Star has to offer. Blue Star is the investing company with a focus on esports and media that surrounds it. And so, with Blue Star, you have exposure to esports teams, esports platforms, and our broader investment thesis, which is what are the up and coming industry segments that we want to hitch onto as the wave rises.
Yeah, very hot areas. So let's start with the esports section. You've done very well on some investments here. So Guild, I know some people will be aware of because it's listed in the UK. Take us through what you've achieved there, Derek, and anything you want to pull out from that.
We're really excited, Justin, about our investment in Guild. When I joined Blue Star in the fall of 2019, Guild was one of our first investments. To date, we've invested something north of £700,000 in Guild. And as it's a publicly traded company, mark to market, we can say that investment's worth about £2 million today. So we're really, really pleased with the performance of Guild and are excited with the performance that the executive team at Guild is doing in terms of executing on their business plan.
Yeah, absolutely. And they're building that team, won some awards there. And so let's go to Dynasty as well. Again, you performed very well investment-wise here, but maybe some people aren't as familiar with Dynasty. What is it then, Derek?
Yeah, so a Dynasty, and I mean, I'm laughing to myself and now aloud because I say Dynasty over here in Canada, okay. But I'm starting to say Dynasty a lot more. Yeah. So Dynasty is our Malaysian-based platform company. So the exciting thing about esports is it's a broader market opportunity than just the teams and the championships. That's clearly the public-facing piece that everyone sees. Everyone sees Guild competing at the Fortnite Championship, which it won in March. Everyone sees Guild competing at the EU Spring Series Regional, which it won a trophy at in April. So that's public. That's public, and you can see it. But where does all that happen? It happens on a platform, right? People have to gather on an electronic platform to compete in esports, and that's what Dynasty is. It's a white label platform solution with some major telecom clients that they're providing their services to, and also to nations. I mean, the Malaysian Esports Federation is using their platform to conduct the Malaysian Esports Federation's competitions, esports competitions on.
Yeah, and just to rewind a bit there, and you talk about, people maybe, my kids are obsessed with gaming, I know, and they know lots of esports stars and stuff, but for example, with Guild, how do Guild make their money? Just sponsorships, and how does it work?
Yeah, so I mean, esports generally is a media opportunity, the same way Premiership League is, the same way the NFL is, and so in all of those opportunities, there is sponsorship, a huge part of it, and in the case of Guild, they just signed a deal with Subway, multi-year, multi-million pound, multi nations. I mean, the entire EMEA region is covered by that deal. They do. These opportunities earn revenue through tournaments, right? They earn revenue through fan support. They earn revenue. Fan support can be gauged by, for example, by followers, right? And at Guild, for example, across their stable of influencers, they have probably over 10 million followers, and they just signed one of Europe's hottest female content creators in Nikki Nahachu in early April, and Nikki herself has 5.5 million followers.
Wow! So
those are the opportunities that exist in esports.
Yeah. And when you say that, it makes complete sense. It's pretty much like regular sort of sports teams, I suppose, and it's getting bigger and bigger. I know that, and and of course their reach and those deals will probably get bigger and bigger as well. So let's move on to Satoshi Pay. Just explain that for people and explain maybe if it's had any positive effect from the recent rally in cryptocurrencies and Bitcoin, all that stuff, if you could.
Yeah, I think Satoshi Pay has made a really exciting, has launched a really exciting new product in the product they call D-Transfer. So D-Transfer is designed to simplify the movement of funds across national boundaries. And we think about it how it should be simple, right? We go online and we send our mate a couple pounds for the beer they just bought us last night at the pub. It's super simple, but as soon as that starts to cross nation boundaries, it gets much more difficult. Not just the friction from the foreign exchange, one currency to another, but I think just the different banking systems, the different infrastructure behind that supports those banking systems. And so the blockchain is a fantastic solution to some of that friction. And Satoshi Pay, with their D-Transfer solution, together with the deal they did in December with German Bankhaus, which became the first user of the bank's fully compliant EURB, it's a euro-backed stablecoin, allows now sort of end-to-end transfer of euro-backed stablecoin within the euro region.
Wow. And your investment in there is doing well. I see approximately 1.9 million invested, based on the value of the last fundraise. That's valued at 4.9 million. So yeah, doing very well there. So it's taken with hot sectors and digital sort of currencies and assets. You've invested in NFT Investment PLC. Now there's a lot of hype and hotness around this. Why have you gone in there, and what's it about?
Well, Justin, I think you're right. I mean, when you say, I appreciate the setup when you say we invested in hot sectors. So I think that is a key thesis of or key component of our investment thesis is identifying not necessarily hot sectors, but identifying sectors that are about to rise as a whole, right? Mm-hmm. So I mean, if we can identify sectors that are about to launch, then the old saying, "A rising tide raises all boats," holds true, and our boats will rise, and we feel very strongly that's where we are with NFT technologies. NFT is a sector that is extremely hot right now, and the great thing about the NFT, I mean, we talked about the media opportunities within esports. The media opportunities are tenfold within NFT, right? It's about content and content creation, and what people are able to do with the content that they've created through these NFTs built on the blockchain network.
Yeah, absolutely, and also just in the update there, you've mentioned Leaf Mobile. Give us a bit of detail on that, if you could, Derek.
Yeah, Leaf Mobile is the largest free-to-play gaming company over here in Canada, together with its transformational acquisition of Eastside Games that closed earlier this year. Leaf just released 2020 numbers, and on a combined basis, saw 100% or doubling of results year over year from 2019, and has pathway and pipeline to continue that rapid growth. Yeah.
And in these investments, like you say, you are in very early disruptive tech businesses, and like you say, a rising tide lifts all boats. And so are you going to sit here and just let these appreciate now, or are you always looking for new investments? What's the score?
Well, we're always looking for new opportunities, right? I mean, and we think there's still lots. We think there's still lots of opportunity within esports, right? I mean, it's still the industry is still early and growing, right? And growing. I mean, we talked about the opportunity being similar to Premiership League and to the NFL. I mean, if you look at the championships, the last Super Bowl, which we would have numbers for would have been 2019 pre-COVID, something around 60 million viewers. It's very, very similar numbers for the most recent, again, pre-COVID League of Legends championship, right? So, I mean, the numbers are similar, right?
Mm-hmm. Yeah, absolutely, yeah. And it's only going to get bigger, I think. Like I said, there's lots of people I've seen, more reports coming out saying esports is probably going to be bigger than real sports because it's more accessible, when it's raining outside, you can still play and watch esports, so it doesn't upset. So it's going to be big for a long, long time. And in fact, it's just going to grow, isn't it, really?
I think you're 100% right, and that's why we're excited to be in esports. And to answer your question, we're always looking for new opportunities, both within esports and within this thesis that are there industries that are in the very early stages and poised for dramatic growth, such as NFTs.
Excellent stuff. Okay, Derek, well, listen, every day in the podcast, I highlight the top 5 most followed companies on Vox Markets. To get on that list, of course, people have to hit that follow button on your page. So give us, if you could, 3 reasons why someone should hit that button and add Blue Star Capital to their watch list, please.
Really, really simple. I mean, I think it is the exposure to growing market segments with esports, with NFT, and with our idea of identifying these early stage industries that are going to grow and grow and grow. I think it's also our portfolio performance over the course of 2020. We've seen right now, we see our NAV sitting just north of £12 million. That's up £4 million since the beginning of the year, and the third reason is the discount to NAV that our current market cap has. Currently, our market cap at today's close is somewhere around £7.7 million. Compare that against a £12 million NAV, and there's nothing but upside opportunity.
Marvellous stuff. Derek, good to catch up with you. Hopefully, we'll catch up some more in the not too distant future. Thank you very much.
Thanks, Justin. Great to be here.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now and on video, full surround sound, Technicolor, it's full-time analyst, full in your face, it's Paul Hill. You all right, fella?
Yeah, morning, Justin.
Do you know, quite bullish news. I mean, we sort of knew this, but I mean, you said Bank of England came out this week saying it's going to have growth like we've never seen it since World War II. So you realise we have been through such an historical event, you know, selling off, every country locking down, forced recession. It's an historical thing, but it's good. And I know if you're judging by my wife, then there's a lot of spending going on. I don't know. Halfway through this,
what should we do? Tell me, spill the beans.
Well, I always look at the property market, right? But that's gone berserk. We could talk about that later. I mean, I've seen house prices in my area got by 50% in some areas. It was a ridiculous amount. So I thought, what? And some of them are just chancing their arm, I think. You know, because they know it's a stamp duty holiday and all that stuff. So we decided to spend on the house we're in. So a new patio, there's new stuff happening at the front, like sort of rendering and all that kind of stuff going on, and new sofas, painting inside the house.
So she's the reason for the sort of the governor of the Bank of England upgrading GDP estimates.
Well, I'm assuming the governor's wife is doing the same, probably. So I think, hang on, this is what we base our spending on. It's almost like that one up on Wall Street, isn't it? The book where he says, base your investment decisions on people around you, trends you see happening. Sometimes you can get one up on Wall Street by just seeing what normal people are doing, and seeing what's happening. There's certain brands. I remember a long time back. Who was it? The clothes company which was listed, part of Associated British Foods. Primark it was, wasn't it? Yeah. And Primark became very, very popular. And I thought, wow, but the trouble is, it wasn't obviously a solely listed company. That's the problem. But and everyone's like, well, Primark, and that was way before the share price really caught on, or it took off a little bit. But those kind of things, you can sense those kind of trends happening, can't you, sometimes, around you.
I mean, you raise a very good point. I mean, just look at the reports and the results from the building materials and building products industry. All of those suppliers are just like knocking the ball out of the park, not only on volume, they've got very short supply, there aren't enough stocks, like the bricks, for instance, but also pricing. Pricing's really moving on. And then what's happening is that's then being put into the repair, maintenance, installation, which is people like yourself who are upgrading the houses, etc. They've got plenty of money because they've been saving for 12 months, and then you've got new people buying houses, whether it's existing properties and then they want to do repair it, etc., or alternatively a new property. And just look at the house builders, and they're passing those costs on, so it's not impacting margins. And that's the important bit. Where you want to play in the stock market is companies that have actually pricing power and strong demand. And you've got a double whammy. I mean, you obviously got this huge lift in anything infrastructure, property related, certainly on the residential side. But also, I mean, you look at the announcements from the government, and everybody's going to be, not everybody, but a lot of people are going to be forced to staycation this year. And that's another real rocket underneath the GDP. And that's why it's moved their estimates from 5% for 7% this year, because, it's really tough to even find a campsite, Well,
and not only that, what happens if, I've talked to some of the guy, Jamie here, who's got 4 guys working with on the patio, and I said, are you busy? He said, we're booked out for months. I spoke to a plumber coming to do some plumbing. He said, I'm booked out till January. It's literally that busy. You see that knock-on effect. And in fact, another bit of news here. Let me just, I found it, I don't know if you saw this, but TUI now, and this sort of plays into some of the stocks you've talked about previously, they're going to start subsidizing, tests, aren't they? COVID tests. Because, of course, you've got to have this now. And you can, is it this weekend or next weekend? They're going to start talking about the green light destinations. Yeah, because the destinations you can travel to safely. But obviously, some destinations still need tests and come back in. But some saying that's very expensive. And now TUI, the biggest operator, saying we'll subsidize that, and you can get them for between 20 and 90. So what's the difference between 20 and 90? Is that the speed of the test or the quality? It can't be the quality. It's going to be speed, is it? I don't understand wide range.
I don't know what they're asking. I mean, normally 90 is probably a PCR test. Probably a lateral flow is a 20. I don't know. They're probably, that's the likelihood. It's just a different sort of price point for a different sort of level of accuracy with what you want. And obviously, if you have a lateral flow, then you're going to run the risk if you get to the other destination and you're going to get a negative PCR. I don't know how they're actually pricing it. But yeah, that's good news. I mean, I did see it's going to be a slow burn, though, on the reopening, because I think there's only Portugal, Malta, and Gibraltar in Europe who are going to be opened up.
I bet they're rubbing their hands, and then
America's likely to be on a sort of like a corridor, one of these safe corridors with the UK, because they've got similar levels of vaccination rates. But I think Spain and France are still on amber, or going to be. So that's going to again incentivize people to stay at home, spend at home. And again, you try and actually book a flipping restaurant, seat. I mean, there were some quite good stats actually. Last week they had only because even though you're only allowed to sit outside, 70%. We were back to levels of 70% of pre-pandemic levels of people sitting down and dining. And that's outside in the rain during hailstorms. And I've seen people.
Yeah, well, do you know what? My local public said they've really developed the outside area, almost covered it pretty much.
Yes.
With a nice booze and all that stuff. So now when they go back to normal, they'll have double the capacity. You can have people sitting outside with heaters and all that stuff, and inside. So they'll have double the capacity. So it'll really benefit them in the long run. But like I say, they're going to get so busy holidays. In fact, another bit of news from the chief executive of Booking.com said, holiday prices are already going up. There's limited. They're hoping to get 70% of. I think that's quite ambitious, but there's limited. Airlines flights schedules on, and you got all these people wanting to go to 3 countries. I mean, if you're in those countries, what are you going to do? Check at your prices, aren't you? The demand's going to be huge. You know?
And also you look at sort of like credit card spend, and in the latest data for the last 3 weeks, we've basically been back to pre-pandemic levels, 99% of what it was the week before we went into lockdown. So frankly, credit card spending's back there. And if you look at, you've probably noticed as well, the amount of traffic on the road. I mean, I had a quick look at the Apple mobility data from iPhones, and across Europe, across England, then we're past where we were in February of last year, slightly higher in terms of the number of congestion. We're not on public transport. So it just says to me, the economy is healing. We still haven't yet got out fully into lockdown. There's massive pent-up demand. So, I mean, I could actually see this 7% GDP increase estimate by the Bank of England being upgraded again, because people are going to, they just want to spend, don't they? I mean, they want to get out.
Do you know what the worry? Yeah, exactly. But the worry about this, like you say, there's pent-up demand. So the demand is there, but supply isn't quite there on many things. And we know what happens then. So you've got pricing. Exactly, and inflation. So because you've got, but again,
what have I been saying?
but surely, I mean, for example, with flights and holidays, let's say it's a limited destination you go to. There are countries behind us on their vaccination programs, of course, and there's variants and all that stuff. So they will be slower coming, to open up. So, you'll have this, I think, but it may peak though. Isn't it temporary, transitional, this inflation? It'll come back down once, because it is all about vaccinations and testing pretty much. Vaccinations, isn't it?
Yeah, I mean, that's what the Bank of England governor says, and likewise the guy over in the Fed, Jerome Powell. But I've said to you many times, I don't believe it's just transitional. Yes, you'll get a spike and then it'll come down a bit, but there's no way it's going to hit 2%. And there's lots of reasons why. But the biggest single one is that governments are absolutely saddled with huge mountains, Himalayas of, sort of debt. And the only way they can rebalance that in terms of GDP is to inflate it gradually away of sort of like 3, 4, 5%, and that's what will happen. And then you'll get it. You'll have that coming back to sort of 100% of GDP total government debt in about 5-10 years time. And people will say, well, okay, well, fine. The only way you can protect yourself is to have assets, stocks, houses, and things like gold and other physical assets. I mean, people say Bitcoin's a safe haven. It's about as safe as probably my DIY, I think, but which isn't very.
I'm genuinely. I think the crypto market is insane. The fact that I attempted into it a couple of weeks back means it's insane. Like I say, you got Dogecoin valued at 80 billion, which is like more highly valued than most FTSE 100 companies that are proper businesses. That's a picture of a dog. That doesn't simplify how insane or crazy that crypto world is. But people believe in it, It's like anything. When you get herds of people believing, chanting the same thing, believing it, I think Ethereum is probably, the best one to hold, probably because that's like the internet of all apps, all decentralized apps are based on Ethereum, pretty much. Bitcoin, okay, maybe it's an asset, but the rest of them, they can fall by 95% in valuation and they'll still be overvalued. It's like, who knows what they do? It's like nuts. I know people are probably listening and watching this saying, no, you just don't understand it. It's all about decentralization. It doesn't matter. In fact, I read a startup guy very good. I should retweet it, but he was talking about he had a project on about crypto, and he was saying that basically when you're in crypto and trying to develop this coin, you long for centralization. You need centralization to get the decentralization and all that stuff. It was very interesting. But yeah, no, I think it's super valuable, and I'm wondering because now we got the crossover mainstream investing in crypto, whether a big sell-off in that will lead to a bit of a sell-off in the real market. First time
hey, mate, I pointed that out about 2 months ago. I said that was a big risk. You could have it. It could actually take a lot of momentum out of the market, and you could get a selling beget selling. But before we move on, off the sort of like the the COVID testing side, which you mentioned, if people go abroad, they've got to have PCR tests and people and TUI are subsidising and stuff. That is a really interesting space to play, and for a number of reasons. First of all, and I've talked about it a bit, SourceBio do PCR testing, and if everybody's got to get PCR tested twice who go abroad, then that's going to do well. What was also really interesting is I didn't realise, but the UK government at the moment is sequencing every single positive, or nearly every single positive, COVID infection result, and all that means when you spoke to Jay LeCue at the Polarean, he said to you, we're actually our genomic sequencing division is doing really well. Well, that's the reason why. He's simply everybody in the UK is having to have their tests with a positive test sequenced, so they're going to do well in that respect. And then also the other reason why it's really interesting, in just the broad perspective in COVID testing, is the government is very shortly going to decide on what are its default tests for PCR and its suppliers, along with its rapid flow, antigen tests and stuff. And the companies obviously right in play for those are likes of a Vactor, Omega Diagnostics, which have got to test itself and do manufacturing. You've got Novacyte, and you've also got another interesting one. And those decisions I think will be made in the next month or so. The PCR tests, they're coming out. It's lot 3, I think it is the really big one. But anyway, so that's going to be big news. But the other really quite interesting one, which nobody really gets their head around, is actually, when they came out this week, is Oncimmune. And Oncimmune's quite an interesting one because it had first of all some news that its lead cancer early detection screen, it was taking back the rights and the IPR from its Chinese distributor back into the UK. And that's great because it gives them the flexibility then to, if it wants to, hypothetically, if ever wanted to bring that, dovetail its test with its partners in the US, Biodesics, then combining those two, you get a really balanced test, and you can potentially put it out even into China. And obviously everybody knows that smoking is massive in China and lung cancer is huge. So but coming back on the COVID side, which is again something people haven't really seen, is they've done an infectious disease panel for COVID. And one of the real killers of COVID, as everybody knows, is this COVID storm, where you get a huge autoimmune reaction. And it basically attacks your body, all your lungs. But also there was a Yale study not long ago, which was one of the reasons they're saying this autoimmune response has caused long COVID, because it damages your brain, it damages your lungs and stuff like that. Who is in the able position with one of the world's biggest auto antibody biobanks in the world? It's about 8,000 or plus proteins it's analysed. It's Oncimmune. And that's why Roche and Cedars-Sinai have wanted to actually develop their own products using that unique IPR that Oncimmune have. So they could really do well in an area that people have not seen. So I would say, to people who own this stock, last week's news was fabulous because it gives them that optionality, and also what it allows them to do, which they've said they're going to do, is look to raise some money on the US markets, which could lead to a re-rating. And equally with that, the test that from Biodesics out in the States, their partner, they're coming out results on Monday, I think it is, or it's about the 10th or 11th or something like that. So have a look at those results. But I think this COVID side is really under the radar, because how many people have got long COVID? Well, I know at least there's 10% of the NHS's staff have long COVID. They are desperate to get those guys back to work. And therefore you need leading IPR to help to create the treatments and diagnostics to be able to sort that problem out going forward, never mind obviously the general population. And they're really in a very good position. If Roche can't do this themselves, then that means that they've got something. So I would definitely, have a look at sort of Oncimmune, because I think they're under the radar. People obviously have priced some of but not all of their service, which is the Immuno Insights service and platform. But those things are really good in terms of that infectious disease with COVID and the early CDD test. So something to look forward to, I think. But
yeah. Well, do you know what? Just mentioning long COVID there, I may as well mention Polarean off the back of that, because they've just come up with Stifel, their new big sort of broker they moved to, has come up with their first sort of detailed note on them. And the FDA clearance for their drug device is on the 5th of October. And they've come out with saying 90... Yeah, so 90.
Wow, that is going to be one big day for the shares. Month's time.
I think before that, so upon approval, there's a 90% probability of it happening. Because let's be honest, they've had a pre-FDA meeting. Their phase 3 trials, or all the trials.
If it's 90%, Justin, it's priced in. That's not. You want it?
No. That's. But hang on a second. They've seen a 50% upside on that thing there, and. They're talking about 167 million in revenue by 2030, and that's just basic. Do you know what? I was talking to Richard, and Richard was saying that they're saying, if you look at Stifel, they've got a unique ability, their tech, to visualize 3 vital aspects of lung function. That's ventilation, gas exchange, and microvascular blood flow. And no existing lung imaging technology can provide that. And like I said, Richard said in a recent presentation, within 10 years, they see polarizers in most hospitals. An add-on, or even added manufacturing on MRI scanners, and these are guys that have they applied for what's called Hatch-Waxman exclusivity, 5 to 7 years. So they get that, they'll be supplying the market pretty much, the entire market for 5 to 7 years. So I think 50% upside to the before October is quite conservative. I think it's going to be.
I'll be watching that. We should do a podcast sort of like on the 4th. And we'll run a sweepstake about what the result's going to be.
Well, it's funny that if you look at it, right. So basically, they've had a pre-FDA meeting, the submission, which I think is it's essentially like someone marking your homework before you submit it. The teacher saying, "Okay, maybe we'll look at that." And and also the clinical trials were designed and approved by the FDA, of course, all that stuff, and they passed. So I think it's pretty much. I mean, you never know. But they say 90%. Now they have to say that. They can't say 99%, I suppose. But it seemed pretty much a formal exercise. They may have some kind of issues or collaborative issues, and they go back on. But
can I make a prediction? Can I make a prediction on this one? Right. Let's assume you're correct. Yeah. And that 90% probability.
I always am. Yeah.
Exactly. That 90% probability is right. Okay. And they get FDA approval. I'll make a prediction within 12 months. So let the 4th of October 2022, Polarean would have been bought out by a US MRI scanner, sort of like...
Yeah, well, I mean, there's 2 big...
It's going to be taken out.
There's 2 big diagnostic companies on the whole shares are significant holders. So
okay, well, it might even better than have a fight over it, because if that gets approval, it's a game changer for that technology. And... you'd be crazy if they get approval. If it takes a pop and then comes down a month later, you'd be crazy to sell, because that looks like an absolute perfect acquisition target. And I did a video on this. If you look at the last big sort of milestone, they had was phase 3 announcement. The share price rose by I think like 50-60% beforehand. Within a month before, but 50-60% months before, and then everyone sort of knew they needed to raise some funds, so it literally dipped massively afterwards. And they raised some funds, no problem at all. But that was up to. So sometimes, obviously, with share prices, it's always the same. That's why people don't understand. Sometimes you get some good news out, and the share price goes down. Yeah, look at the chart beforehand. It's risen on the way up to that news, and it's baked in. So So we've got 5 months yet. It's 5 months. I think it was 5 months 2 days ago. It was exactly. So, and who knows? The FDA are probably quite busy at the moment, so it may even be a little bit delayed. Who knows? Yeah. I mean, there's a lot that raises another trend. It's sort of acquisitions and M&A. I mean, obviously, one of the companies I've talked about, Proactis, got taken out last week.
It's a good price, wasn't it? Nice price.
Yeah, well, I mean, it was 75.
75%, yeah.
Well, it was 75p a share, which was roughly about 80% premium to the previous day. It was still actually only taken out on a 2.3 times EV sales multiple, so it wasn't actually that stretching. But it looks like a done deal because the main shareholders have actually agreed. But what it raises that if you've got an undervalued asset on the market, it's not a surprise it gets taken out. I mean, you've had just this morning St Modwin. They're sort of like a land regeneration. They do a lot of sort of like remediation and putting houses up there and retail and all this sort of stuff, building construction and all that kind of stuff. They've redeveloped Longbridge where I live. Anyway, they've been bought out, or they've had a preliminary offer from Blackstone at another sort of like 20 odd % premium. So M&A is increasingly happening because we talked about inflation. As inflation goes up, it means that assets become very, very valuable, and certainly where you have synergies, then you can justify the prices because people can't make a return on their cash if interest rates are going to stay low and you see inflation. So you might as well invest it in sort of stocks and shares. And as I say, Polarean would be an absolute perfect position, I'd have thought.
Yeah, exactly. No, it's one of those companies, it's the longest one I've held, I think, for a long time. In fact, the last longest share I held was Lloyds after the pre-financial crash. And I went big on that. And I said big. For me at the time it was, because I had all my money in it pretty much. And luckily it paid off. But I had some sleepless nights over that one, thinking they're going to nationalise that bank. And I thought, if they do, the whole economy's in trouble here. But it paid off. But I mean, I held Lloyds there for 2 years maybe. But now I've held this close to 3 years probably. But it's done very well,
Talk about holding periods. I mean, we've obviously got, I don't know if you ever met the guy, Zak Mir, who's now joined Volt. Yeah. He's an expert.
I used to have Zak on every day. Every day, three charts in 3 minutes with Zak, on the podcast years ago. But nice guy, Zak,
Yeah, well, he's an expert on all things chartist related, and I've challenged him because I'm an idiot when it comes to sort of the technical side. And I've said to him, right, next week I'm going to interview you, and you're going to take me through. And he's kindly accepted the challenge, my portfolio, to see where the fundamentals and the technicals align. So,
do you know what? I never look at. I mean, I see a lot of people doing charts and doing forecasts. You can't do that. You can't, I mean, I just think that's like Mystic Meg kind of stuff. All I use charts for is I look at the price action or the volume on something, or a good indicator I look at is all the relative strength index, which is based on volume and price movement. It's based on momentum of a share price movement based on volume. So it's real metrics. And then I look at, say, and it's valid from 0 to 100. Over 70 is regarded as overbought. That's when there's a lot of momentum going there, and it needs to calm down a bit sometimes, but it can be higher than that. And then all I look at is previous times it's done that, saying, okay, last 3 times it's gone above that, or above 80. It's come down within the next week. And so it helps you just time a little bit and don't buy a very hot share price. We all know share price go up and down, and the business underneath, it can be improving, but the share price can go down. So it's like, I look at charts to help me with a bit of fear of missing out. Think, hang on, it's way too hot. Last couple of times it's done that, it's come back. It's consolidated, So, yeah, that's what I use charts for. So fundamentals, what to buy, charts, when to sort of buy really, because if you want to check it's not gone crazy in the last few sessions or something, so that's what I use it for. But the predictions and forecasting, I see a lot of people drawing these lines everywhere, going nuts. It should hit £10 by September. No. Well, you can actually do that
anyway. There's a dry
if you can actually predict those kind of price movements, you'd be tanking Warren Buffett, absolutely you would. You wouldn't. So yeah, I never believe in forecasts. So probability I use charts for really, and just that's it.
Well, if anybody's interested, my fundamentals based investing, 12 stocks in there are all going to be sort of like he's running the slider all over them, and one of them was coming back to one of your longest holders, Lloyds, has actually done really well. I mean, it had its trading update the other day, and surprise, it said it was releasing its provisions, or quite a large chunk of its provisions from last year. It now has around £6 billion of surplus capital that could well be heading back to shareholders, which is around about 8p a share. And it's still not expensive, but that one's recovering. And I've sort of like, come to the conclusion that one's going back to sort of like, net tangible assets around about 55p. So there's no reason not to continue with it. And equally, I would say, let me just get rid of that.
That's Zak probably calling you up.
Sorry about that. we get these crazy people who ring me up and try and sell me stuff. And then the other stuff that came through in terms of my portfolio had Merck and Gilead, and surprise, because patients and people who are sick haven't been able to get screened for cancer and for other conditions, haven't been to GPs and to hospitals. They're sort of like anything that's drug related, which is associated with hospitals or GPs, hasn't actually done so well. And so they came out, they had missed expectations on their core businesses in Q1. The shares sold off, but then people realise it's all coming back, and they've moved back up. So that one's just as good sort of work in progress. And that brings me neatly onto a company that I interviewed CEO Wendy Lawrence of Totally this week. And if anybody's interested, it is well worth a listen to, because she gave me the rundown on the actual business. And essentially, they do the 111 urgent care service for the NHS. Now, what's really interesting about that, there's two things. First of all, they managed to increase their capacity 4 times during the pandemic, from pre-pandemic to the top of the sort of like infection peak in February. And also, the NHS likes the service so much, they're thinking about using it for, in fact, they may have already announced it, I'm not sure, for GP. So instead of ringing a GP surgery to book an appointment, you ring them, which again will continue to drive that. But the real beauty, I mean, the other real beauty comes in with the, sort of their planned care and their insourcing divisions, which are going to help the NHS get rid of the mountain of patient waiting list of 4.7. And that's just really tip of the iceberg, because there's so many people who haven't been screened over the last 12 months. It means that list is going to increase significantly. And I say I saw that with Merck, and I saw it with Gilead's results. They said exactly the same. So what that means then going forward, and I put this question to Wendy, and she said, well, we don't know. Who knows how it's going to go? But we're really confident in our insourcing division, which basically brings in their teams of surgeons and healthcare experts, and does operations on NHS patients in NHS hospitals, and that's why it's called insourcing, over weekends when that equipment's not being used to help get the patient list down. And she said, well, we could see it doubling this year and doubling again next year. And if you run that through, plus the mix in margin, I mean, last year in 2019, I think they did something like into March 2020, it's about 105 million of turnover, 4 million of adjusted EBITDA. I could see in 5 years' time, not a problem, them doing 200 million of turnover, 20 million of EBITDA. And given their market cap's only 70 million, plus they've got almost 15 million of net cash, this looks like a real sort of like, undervalued share that's got long-term growth, secular growth drivers driving it. And the quality of that business, having just come through a pandemic and to stand shoulder to shoulder with the NHS it's been road tested. It's fabulous. The amount of goodwill that company has built up from the UK and from just generally the public from doing a terrific service means that they've got every chance of winning more business and absorbing more business from, as the NHS, frankly, are going to continue to really struggle because they've got unprecedented demand coming forward. So if you want a long-term sort of like small cap, £70 million, sort of like companies to have a look for in healthcare, Total is as good as any. So yeah, I would have a look at that. I was really impressed. She's a top, executive in my view. She knows, she comes out to the NHS and she really knows what they need in terms of, making sure that the quality is first and foremost, both to the patient and to the actual hospital itself.
Yeah, I've interviewed Wendy a few times, and about years ago, I used to hold Totally, and
well, mate, if you ordered about 10p, they're about 40 now, so you'd have 4 bagged.
Yeah, it's another one I had lack of patience on, and
another one. Yeah. Another one you had lack of patience on was Eleco, mate, and that came out. They came out with a trading update ahead of its AGM, and this is certain. I mean, I've owned this for 5 years. And they came out with unbelievably good numbers. They said previously, about a month ago, 6 weeks ago, that their year-to-date like-for-like sales, which is the missing piece in the jigsaw for this whole sort of like build tech story, had been 4% up to February. But for March, that year-to-date like-for-like sales growth had risen to 9%. And if you do the maths, that works out between 15 to 20% like-for-like growth in that particular month, which is absolutely fabulous. And if they can continue that, they'll absolutely knock the ball out of the park this year. Now, what was really interesting was that their house broker, FinCap, didn't upgrade their numbers. They kept them the same. And that was largely, in my view, just on ultra caution, because I think they're going to beat FinCap's numbers. But also, there's lots of levers that Eleco can pull. If it wants to, and just sort of like, get over what the market's expecting, then it can really accelerate its SaaS transition. It's about 56% last year, it was the share of revenue. But it can really accelerate that transition from a perpetual model to a SaaS model. And therefore, that dampens your sales growth. Or if it really wants to do a like-for-like, it'll probably knock the ball out of the park and do 10% plus on like-for-like if it just kept its exactly the same mix of SaaS and perpetual license. So, and most of that just drops straight down to the bottom line because it's 90% gross margins. The cash is just fabulous. They're on about, I don't know, I can't remember what it was. It was about 7.9 million net cash at the end of March. PBT increased by 21%. So they've got lots and lots of, levers they can pull. If they want to put in more investment in there, they can, because FinCap numbers is a very easy bar to get over in the top line and the bottom line, in my view. So I am absolutely delighted that business is really motoring. And I can tell you, I'm just going to hold this one because...
Do you worry, though, about it's stamp duty? Like I said, we've seen house prices rocket recently, and that kind of stimulus is always a bit worrying when it's a bit of a bubble, don't you think? I mean, because I said genuinely, I've seen house prices go up. Because I always watch, I'm always on the portals watching the prices, and I've seen them literally move up in the last month or two crazily, and I think that's ridiculous. I've seen houses worth something like 700 grand being priced at $1 million. I thought, no, your house is not like that. And they're just trying their arm. Do you sort of worry? I mean, do you still hold Taylor Wimpey and stuff? I mean, do you think
just default to what Taylor Wimpey said like 2 weeks ago, on their trading update? The CEO said, stamp duty, yes, it's helping, but frankly, take it away. It doesn't make any difference. It won't make any significant difference. There'll still be huge amounts of house demand, and all of them have said the same. So, what the house building industry is saying to the Chancellor, take it away. We don't need it. The demand is still going to be there. We can.
I think they should take it away. I think it's inflating the prices. I've heard a lot of stories of people being gazumped, and people are offering house offers on not even seeing houses, and I think it does off that sort of frothy herds mentality of people just, I need to buy a house. I remember it happening years back. I don't know. I was in Cardiff at the time, and I was trying to buy a place. It's just crazy. You get caught up when you're trying to get on the first rung of the ladder, the property ladder. You just can't afford it anyway, and you overstretch yourselves. And I think it's a bit worrying sometimes.
Yeah, it won't make any difference to the building industry, in my view. No. The demand is still there. And what you've also got, if you're going to get a continued strength in the housing market, you've also got all big infrastructure projects coming back. I mean, HS2 is really flying at the moment. And then you've got lots of other big infrastructure projects which are going to be happening. So I can't see, construction is going to be really strong for the next 12, 18 months. I just can't. And the stamp duty holiday is just a bit of noise, in my view.
Yeah, absolutely.
When it comes to Eleco, I mean, I'm just going to continue to hold that. The new management team have just grabbed that business by the scruff of the neck and really now delivering on the top line. So
how long have you held that?
I think I first bought shares around about 2015, 16, something like that. So that's where I bought most of them. I actually think it's now my biggest position. It's one of the biggest positions. So looks like a home.
I'm scrolling back to 2015, 2016. We're talking about 20 pence there. Now it's 120.
Yeah, I think
25 pence.
I can't remember what the average price is. It's about 25, 30p or something like that. I don't know. But when I first started in microcaps, because on Twitter, and I talk about this, and I've pre-recorded already the weekend podcast, I talked about looking at companies going to be generating real value, and I say that by cash. There's a lot of there's some good companies on AIM, and AIM gets a bad name because there's a lot of resource stocks that get pumped and news driven. They've got no revenue, and they're not going to be generating real value. I call real value, which is cash, anywhere in the distant future. And so you've got to trade those. And so if you're new and you think you can hold on to a company that's a resource company, you can't really, unless they're going to start generating cash flow in the next 6 months or something. You can't. So always look for companies they're going to be good businesses, going to get better, generating real cash flow with
within 6 to 12 months and improving that over time, and you can sit and hold. And that's the best way, isn't it, to create your own wealth? Just sit and hold in good businesses, not jumping in, jumping out, top slicing here, top slicing there. It's a false economy. That,
and that's coming from a trader.
No, I'm not a dirty trader. Listen, I tell you what, I used to, when I first started in microcaps, when you're in a smaller pot, you have to go down the market cap size, to build up your pot a little bit. There's no point in you getting 5-10% a year if you've only got, if you've only got a couple of grand or whatever in your pot. You can't. You need to double, treble your money. So you have to take on more risk. But and sometimes that means going in resource stocks. But you can't hold them forever. You can't. I think. Hang on. Someone said to me once, of the resource companies, explorers and resource companies, explorers basically, only just less than 3% will ever get to become a producer. But if you look at that, what really? And this is a guy in the money industry,
Ask me a question, Justin. I'll tell you what the question is to ask me. Okay,
go on then.
How many resource explorer stocks have I ever owned?
Oh, you used to love them, didn't you? So there used to be a portfolio was full of them. They used to call you Paul Resource
Zero.
Zero. No, I know. But that's right. People, I said on the weekend podcast, do me a favour. Look at the top 1,000 richest people in the world. See how many of those are traders. See how many of those are investors. That gives you the answer. There'll be a lot of investors in there. There'll be no traders in there, And so to build real wealth, you have to buy a small company, but has the potential to scale. And you can just get in early and hold on, because that's where the balls are. The trading is not where the balls are. The balls are taking a nice little stake early on. And, it's sort of course, it's never going to run smooth. No business runs smooth. But as long as the general story is unfolding as you expect, holding on, ups and downs, and then all of a sudden it'll start rising. I saw a guy on CNBC once, and he said, listen, holding on is where you make the money. I think he said, if you look at Amazon, it's been so volatile. The drawdowns on that's been so volatile. And I think probably Jeff and maybe his wife are the only two people that held shares from the start to the end. But that is where the real monies are made. There were times during .com, bust where everyone said Amazon's going through. If you looked at Amazon versus eBay and the capital spend on Amazon given to eBay, Amazon can't afford to open warehouses, hold stock and all that stuff. And yet, look where Amazon are now, and eBay's been crushed pretty much, So, it's almost having that.
Basically comes as a good sort of principle. The reason why I avoid those type of really sort of like, bullet point type sort of like stocks, etc., is simply because the hit rate's so poor on them. And I just don't like having a 90% chance of losing money and a 10% chance of 10 bagging, because it just doesn't work. I just don't like that sort of optionality. I'd much prefer it sort of like a 60-70% chance of it being a winner and a chance of making 50 to 100% of your money. Those are the type of stocks I like, rather than actually trying to bet the farm on a one-shot, one-trick pony sort of stuff, particularly with a probability of only 10% of success. So I try and avoid that. Now, what percentage of cash is in your portfolio? Just
I'd say round about the same. I say 10% on that. It's not round about that level.
Somebody tweeted that you'd sold your Trackwise Designs apparently.
Yeah. So, do you know what? I'm starting off obviously the Shafiq Investment Club, and it's what's nice about trying to help others is you learn yourself as well, because you have to look things up and you look at your previous results and you have to really dig deep. And I've just gone over my previous winners, and they're of a certain level, certain size. They're doing a certain thing that maybe in turnaround it takes a while, but there's certain metrics you look at. You understand they're going to be heading towards cash flow positive within sort of 12 months. And I like that, going from almost loss making. If you can get that loss making where sentiment's low and they've been raising money and they get to the stage where they find it hard to raise money, all of a sudden they've turned it around. They're starting to come together. The business model is coming together, and that kind of, and I've held too many stocks as well. Just looking at diversification, having too many protects you against risk, yes, but it also protects you against reward. It's really hard to get some decent upside if you've got 20 stocks or something like that. It's really hard. You'll follow the market pretty much. So
how many have you got How many have you got at the moment?
I've got 6 serious, but 9. I got a total. Yeah. And Trackwise is one. I like it, but I missed the big move in that. They came on the podcast when they first listed, and I liked it. I didn't understand the tech too much, but I sort of liked it. You get this inkling, I quite like this. I don't know why, and I should have gone in there, and it moved. And I see potential 2-3 years out, but I look at my stocks. I've got to bring in below 10 stocks. I held about 13 now, I think it was. And it gets to the stage where, what are my core holdings? What do I not want to sell, definitely? And then I start with one, then go to the next one. I don't want to sell that either for these reasons. And then I get to say, 6. And okay, I'm just going to get rid of the rest. And that's it. I don't need the rest because it's just diluting thing. So that's what I've done. And Trackwise, I think, good potential. But again, we talked about this. It's most sales you see from, sort of high net worths or from funds. Most of the time, it's nothing to do with the company. It's their subjective position. They need to readjust their book or whatever, or high net worth take some profit. Yeah, so it's just that. It's just my I said to something, I said, don't base my sales on anything, because I jumped out of some companies that have done 3,000%. Before after.
So have I.
Yeah. So it's nothing to do with that. It's just my own personal, sort of portfolio management. That's what it is. Yeah. So.
Have you got your eye on anything at all going forward, or plenty? You just sort of like.
I've always got my eye on things, always, Okay, but I mean, it's come back to the thing. I mean, I do like at the moment. My core at the moment, little 3 are like, Polarean, Escape, and Infinity. I like them. They're turning around. They're getting better as businesses.
Which sector is it? Is it basically going to stay healthcare and tech? Is that your sort of your prime?
Yeah. Well, it's small tech based, but anything in a hot sector. But even now, I mean. I can't help having a little dabble sometimes on a reopening trade. I see reopening going to happen very soon. I see some companies leverage the retail sector, and I think that's a tiny market cap compared to where it was. Okay, they've got some risk there, but as we know, fear is our friend sometimes. If you get good management, a decent business model, very few companies go through. You can have a big hit. But this company, some of them are priced to fail, and I think, okay, I can't put a lot in it because it's not very big. And I don't want to talk about it because it's not. I wouldn't say this is amazing business, but I just think it'll do well on a reopening. So there's a couple I've taken of that. There's one I took recently, which was bombed out, and then a big fundraise happened, and some big guys came in. I thought, what's going on there? And so I like the tech, but it's always been bombed out. I'm not going to say it because it's basically tiny market caps, and I don't think they're amazing businesses yet. And I sort of don't want to promote them in any way. I haven't got hardly anything in them because they're too small. I can't really get any foothold. But I think you've got to have those kind of little plays sometimes. Well, you do. No,
it's awful.
But I'm already. Listen, I said buy 2 companies, and literally I'm already up over 40% in one, and 20% in the other, and it's just I want to see where it goes. It's not. Because I think it could be over time even. They could get better, but who knows? But I may even just... I have one of those where one day I said, no, listen, I want more cash. I'll just dump them. And so that's why I don't share them. That's why I don't share them, because people say, you just trade them. Yeah, I am, but I'm not promoting them. So I'm letting them go in their own steam pretty much, So,
okay, I would say, from my own personal experience, if you want to absolutely generate long-lasting, serious returns...
I agree.
You've got to have... Only invest, and you've got to be patient. You've got to be disciplined, disciplined. Only invest in high conviction plays. Don't
absolutely.
Don't start diluting it in stuff. Okay, this sounds good.
I won't. I said no. I agree, and I said I'm never going to hold more than 9 stocks ever. Only 6 I'll play seriously. Yeah. But 9 are the ones. One of the core principles of this investment club I've got is saying, if you are holding 20 stocks, even 10 or more, you haven't done enough research and you don't have enough conviction. Because most of the people in my club are not millionaires. They are average or private investors, some of them starting out. And so I said, what you need to do, if you want diversification, get a fund. If that's all you want, and you want decent market returns. But you've got to research the company enough to have confidence in the company. So when the share price goes down, you realize that isn't the business being affected. The business is the same, it should be improving. Don't worry about the day-to-day pricing of the business. That's the market. You just worry about the business itself, not the price of the business on a daily basis. And I say, you need to if you get decent returns, I say, you've got to have conviction in a handful of stocks, 5-6 stocks, and that's it.
And prepare to take a long-term time horizon on it.
Yeah, another one. Do you see this company in 3 years' time being a lot better than where it is now? And if you can see that, don't worry about the daily movement of the share price. That's going to happen, isn't it?
It takes a long time for the market sometimes, particularly in small caps, to catch up with what you've seen. And you've got to be prepared to be patient. I mean, it's taken me 2, 3, 4 years on certain stocks. So you have to be patient.
Spot on. Do you know what? I've done that. That's why I jumped out of things. I got into they're hope, hype potential stocks. But I got into things like, Argo blockchain, I was in the Powerhouse Energy, and I was talking about that, and there's an alternative energy, and you realise the market's a little bit behind you. You've researched them. This company's only worth 10 million, and it did 6-7 bags within a month. All of a sudden, everyone's going carbon zero, net zero, and they think, oh, there we are, Powerhouse Energy, gas or hybrid syngas, Bitcoin for ages. I did some videos on that, and Bitcoin, then it's videos on the blockchain, and then I lost patience, and all of a sudden hit 3,000%. What the heck? So now you have got to stick in there, have patience, like you say, and if you're good business improving, it's in a long trend sector, you're okay, and just having that patience, isn't it? I realise that after a while.
If anybody, as a trick, if anybody sort of gets close to that impulsive button to push a sort of a buy on a short-term trade, then just go and have a cold shower, okay? Because that'll stop you. To you, because those tend to be low probability investments and good gambles. So why bother?
Well, the thing is with trading is this. So I genuinely don't. This is why I do always have to go at dirty traders, jump in and jump out 20%. I think, what's the point? What is the point of that? Because to me, unless I can get a decent return from it, and that means having 10% or more exposed to it. And I got the conviction to take that position. There's no point me trading it. If I'm going to get less than 2% of my portfolio, no point me. It's not going to. And we have this. There's a lot of people, as they've started in the club, and they've got 40, 50 stocks, and they've whittled them down now. As they're looking at what's your conviction, which one are you really convinced of, and it's the one you've done most research on normally, And I said normally, if you're worried about stock, it's because you don't know much about it. So get rid of it or do more research. And if it holds less than, say, 5% of your portfolio, either do more research and up your exposure or get rid of it because it's not doing your portfolio any good. So, and normally that's it. People have worry about a stock because they haven't researched it enough. But trading is the same. I can't trade because I need to research a company to put a decent chunk in, so I can't really trade. That's why.
Good man. Well, that sounds like you're getting more disciplined.
Yeah. Well, that's it, isn't it? I mean, it's a skill, discipline, patience. It's a skill. Buffett plays a long game. He's 90. I love that. Yeah. But any other stocks you want to talk about?
I think that's it. We got. Cool. 2 weeks' time, then, mate.
That's plenty. Thanks, Paul. Yeah. You got partying on the opening. What's 10 days left on the reopen? 5 trading days, actually. I think that's all it is.
You're joking, mate. Definitely not. No, it's too much for me.
Did you party? Well, but you got some. I tell you what, you've got some cracking escape rooms in there.
I know, exactly. All right, marvelous. Mate. Take care.
Cheers, fella. Speak to you next week.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Dark Trace PLC. Of course, the cybersecurity company floated with a bit of publicity behind it there. 4.5% up to 334.9. At 4, Tekcapital at 15% to 15 pence. At 3, Codal Minerals down 7.5% to 0.185. At 2, ULS Technology up 1.5% to 88.3. And at 1, Bacanora Lithium. It's up just shy of 1%. Of course, takeover deal there, 57.5. Okay, it's time for the top 5 most read RNSs. They are as follows. At 5, Tekcapital, Bellascura intention to float on AIM. At 4, Alba Minerals, Amitsoc update declaration of exploration target. At 3, MGC Pharmaceuticals research update Artemic. At 2, Tizion Life Sciences TLSA interview on Bloomberg TV on the 8th of May. And at 1, Rambler Metals and Mining Rambler Q1 2020 performance and outlook. That's it for the podcast. Thanks for listening. Muchos appreciated.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.